How does an airline lose over $100 million during their busiest, most profitable season of the entire year?
Right.
And yet, somehow, Wall Street is just cheering them on.
It's pretty wild.
It is. So today, we're taking a deep dive into Alaska Air Group's highly paradoxical second quarter 2026 earnings report. They trade under the ticker symbol ALK for those tracking it.
Yeah.
And for you listening right now, whether you're, a retail investor already holding the stock, or maybe someone looking for an entry point, or honestly just a student of complex corporate turnarounds, we're taking a data-forward, highly opinionated approach to figure out what this actually means for your portfolio.
Exactly. We're getting past the PR spin here.
Right, because we need to look at the harsh reality of their balance sheet, this massive technological integration they just pulled off, their aggressive shift toward premium travelers, and ultimately, whether their promise of a $10 per share structural earnings path is an achievable reality, or, just a corporate pipe dream.
Yeah, because the dissonance between the top line revenue and the bottom line net loss this quarter is, it's staggering.
It really is.
You have a company reporting a GAAP net loss of $76 million. And if you strip out the special items, look at their adjusted net loss, it drops even further, down to $102 million.
Wow.
And for anyone tracking the cyclical nature of aviation, the second quarter, which captures that aggressive ramp up into peak summer travel, that is historically the fortress quarter.
Right, the moneymaker.
Exactly. It's the quarter where airlines are supposed to just print cash to sustain themselves through those leaner, winter months.
Which makes a $100 million adjusted loss look like, frankly, a massive red flag on paper.
Oh, absolutely.
But, and this is where it gets interesting, looking at the actual raw data generated by the business, the top line revenue paints a completely contradictory picture.
Yeah, it does.
Like, they had a record $4.1 billion in top line revenue. That is a 10% increase year over year.
Right.
And the kicker is they pulled off that double-digit revenue growth while barely adding any planes to the sky. Their total capacity, it only grew by 1%.
And see, that 1% figure, that is the golden metric for the entire quarter.
Really? Why just 1%?
Well, when you're assessing an airline's operational efficiency, you look at how much money they extract from their existing physical footprint, right?
Okay, yeah.
If you grow revenue by just buying a massive fleet of new planes, that's incredibly capital intensive.
Right, you're just spending money to make money.
Exactly. But Alaska grew their unit revenues, which is the sheer amount of money they make for every single seat they fly a mile, by 8.6%.
That's a big jump.
It's huge. That implies they have fundamentally changed how they price their product, how they manage their inventory, and basically how efficiently they are packing value into the planes they already own.
Okay, but let's play devil's advocate here for a second.
Okay.
If you are generating a record $4.1 billion, right, and you are operating your existing fleet with this surgical precision to squeeze out 8.6% more revenue per seat,
yeah,
where did the money go? How do you still end up losing $76 million?
It vanished into the fuel tanks.
Fuel.
Yep. The primary culprit driving that massive loss was their economic fuel cost, which averaged $4.43 per gallon across the entire quarter.
Wow.
And to give you some historical context there, that represents an absolutely brutal 70% spike year over year.
70%. That's insane.
Yeah. So when your primary non-negotiable operating expense nearly doubles, it just acts like a vacuum on your profit margins.
Yeah.
It completely overrides any of those operational efficiencies you managed to build on the revenue side.
Look, I got to challenge the narrative management is spinning here, though.
Go for it.
Because if I'm an investor looking at a transportation stock, fuel is, it's just the fundamental cost of doing business. You cannot run an airline without jet fuel. Okay. So watching management kind of wave their hands on the earnings call and essentially say, we would have been wildly profitable if it weren't for gas prices.
Yeah.
It feels like a convenient cop-out.
Right, like blaming the weather.
Exactly. It's like a shipping company complaining about the cost of the ocean. Aren't Wall Street analysts seeing right through this fuel excuse?
Well, it's interesting because Wall Street actually approaches this with a very specific bifurcated framework.
Okay.
Analysts divide an airline's financial profile into two buckets: structural components and cyclical components.
So fuel is cyclical.
exactly. Fuel is strictly cyclical, and it's heavily influenced by, geopolitical events, localized refining bottlenecks, global crude oil supply chains. Basically, all factors that are entirely outside the control of the executive team in Seattle.
Right. They can't control the price of oil.
Right. So what analysts actually hold management accountable for is the structural foundation of the business. Like, are they improving their underlying revenue engine? Are they managing their non-fuel costs?
Okay, that makes sense.
Because the thesis is that if you build a structurally dominant revenue engine, you will capture massive upside the second those cyclical fuel prices mean revert.
Oh, I see. And the data from the tail end of the quarter actually provides like a live stress test of that exact thesis, right?
Yes, it does.
Because the term management used repeatedly was the June inflection.
Yep, the June inflection.
So April and May bore the absolute brunt of the financial drag, but the exit velocity of the quarter, like in June, was a totally different financial reality.
Yeah, June, if you look at it isolated, is a masterclass in structural outperformance. In that single month, total revenues spiked 13.2%.
Wow.
And even more incredibly, despite those punishing fuel costs we just outlined remaining elevated, Alaska achieved a double-digit pre-tax margin for that specific month.
So they were highly profitable in June, despite the fuel.
Exactly. It was tangible proof of concept. The underlying operational efficiencies finally compounded to a point where they actually outpaced that 70% fuel drag.
Which, of course, begs the question, what exactly are these structural efficiencies they built?
Right.
Because a 13.2% revenue spike doesn't just, spontaneously happen out of nowhere.
No, it doesn't.
Looking at the operational data, the engine powering that June inflection was this massive, highly risky technological transition they executed in the background.
The PSS migration.
Yeah, following their acquisition of Hawaiian Airlines, they had to merge the two operational systems.
Right. They executed a migration to a single passenger service system, or PSS. And establishing the industry's first dual-brand PSS platform is arguably one of the most consequential milestones in the company's modern history.
And for you listening, if you aren't, deep in aviation IT, the PSS is essentially the central nervous system of the entire airline.
That's a great way to put it.
Yeah, it's the software suite that handles your ticketing, your seating assignments, the complex algorithms dictating dynamic pricing, baggage tracking, and even like the weight and balance calculations for the aircraft itself.
It dictates every single digital interaction a passenger or an employee has with the brand. And historically, migrating a PSS is where airline mergers go to die.
Seriously.
Oh, yeah. We have seen legacy carrier mergers in the past decade where the PSS transition just resulted in cascading system failures.
Like total meltdowns.
Total meltdowns. Crews couldn't be scheduled. Thousands of passengers were left stranded at terminals. And the reputational damage, it took years to repair.
It's like trying to change the entire steel foundation of a skyscraper while all the tenants are still sleeping inside.
Exactly.
The sheer operational risk of flipping the switch on a dual brand system covering a global network is just immense. Yet, they didn't just survive the cutover. Their operational metrics actually improved.
They did. They maintained their status as the #1 airline in the United States for on-time performance year to date.
That's wild.
And, in fact, their on-time performance improved by 5 points year over year during the exact same quarter they ripped out and replaced their central nervous system.
And the consumer data totally reflects that seamlessness too. Post-cutover, their net promoter score, which tracks whether a customer would actually recommend the airline to a friend, it climbed 7 points system-wide.
Yeah.
And in the Hawaiian market specifically, it surged a massive 10 points.
Which is huge.
Right. That tells you the integration wasn't just technically successful, but it actually solved a major pain point for the consumer.
And that pain point is what we call integration friction.
Okay, break that down.
Well, prior to this PSS migration, Alaska and Hawaiian were essentially operating as two distinct businesses that were awkwardly duct-taped together via these clunky code share agreements. So if you were a loyal customer trying to book a complex itinerary, say one that started on an Alaska 737 in Chicago and then connected to a Hawaiian wide-body in Honolulu, the systems just couldn't talk to each other seamlessly.
So it was just a headache for the passenger.
A massive headache. Upgrades wouldn't clear, baggage tracking was completely siloed, and loyalty benefits were just incredibly difficult to honor across that divide.
But by unifying the PSS, all that friction just vanishes overnight.
Goof, gone.
The airline suddenly has global visibility on every single seat and every single passenger in the combined network. And that technological visibility is exactly what unlocks the revenue growth we're talking about.
Exactly.
Now that their nervous system can process a passenger seamlessly from booking all the way to boarding, they're completely changing what that passenger is actually buying.
Yeah, the transcript reveals a really massive, deliberate shift away from the traditional, budget-friendly economy ticket.
Right.
The pivot toward premium demand is really the cornerstone of their new revenue strategy. Premium revenues surged 15% in the second quarter.
15%.
Yep. And to put that in perspective, premium seating now accounts for a staggering 35% of their total top-line revenue.
Yeah, over a third.
Over a third. They aren't just passively waiting for business travelers to return either. They are aggressively modifying the physical layout of their fleet to capture this specific demand.
Yeah, they spent the quarter aggressively retrofitting the existing 737 fleet. By modifying the cabin configurations, they dumped 1.3 million incremental first class and premium class seats into the market.
Right.
And what's fascinating is that the demand elasticity held up. They added massive supply to the front of the plane, and the market just absorbed it instantly, which is what drove that 15% revenue surge.
And the composition of who is actually sitting in those premium seats is equally important.
Okay, who is it?
It is heavily weighted toward corporate road warriors.
The business travelers.
Exactly. The data on their managed corporate travel segment is incredible. Corporate revenues were up 30% in Q2, and management noted a clear acceleration heading into the third quarter. July, corporate revenues were pacing over a 40% increase.
40%, that's massive. And the regional dominance they are establishing with this corporate demographic, that is a massive competitive moat.
It really is.
Because they crossed a historic threshold in Portland this quarter, securing over a 50% share of all managed corporate revenue out of that specific market.
Yeah.
When an airline controls more than half of the highly lucrative last-minute business travel in a major metropolitan hub, they essentially dictate the pricing power for that entire region.
But, the truly disruptive financial engine buried in this earnings report, the piece that completely redefines the modern airline business model, is the loyalty flywheel.
Oh, yes. Let's talk about Atmos.
Their Atmos loyalty program is generating financial returns that honestly look a lot more like a major fintech platform than a regional airline.
Right. The co-brand remuneration number is the one that just jumps right off the page.
Yeah.
For you listening, this is the pure cash they receive from their banking partner for the co-branded credit card. And in this single quarter, that cash injection hit $663 million.
Unbelievable.
That is a 19% increase year over year. $663 million in 90 days, generated without flying a single airplane.
And to understand the mechanics of why that number is so high, you kind of have to look at how airlines actually interact with banks.
Right. It's not just a branding deal.
No, not at all. The airline effectively mints a digital currency, their frequent flyer miles. They sell those miles by the billions to their banking partner at a premium.
Okay.
The bank then uses those miles to incentivize consumer credit card spending. For Alaska, this dual brand integration accelerated this flywheel exponentially.
Because they have more reach now.
Exactly. Atmos active members are up 15% across the board. But in Hawaii, they saw a massive 73% surge in new co-branded cardholders.
73%.
Just from the integration.
And they are also using hard product upgrades to lock those members into the ecosystem. Right.
Yeah, absolutely.
They are aggressively rolling out Starlink Wi-Fi across the fleet, and the flights equipped with the satellite internet are charting a 20% higher guest satisfaction rate compared to the legacy aircraft.
Right, it's a huge perk.
But, okay, let's take a step back and look at the broader implications for you, the everyday consumer listening to this.
Sure.
Because if 35% of revenue is premium seats and hundreds of millions are coming from credit card swipes, it looks like more than half of every revenue dollar is now generated entirely outside the main cabin.
That's right.
So is the basic economy seat officially dead? Is management effectively abandoning the budget traveler?
I wouldn't say they are abandoning the budget traveler, but they are absolutely insulating themselves from the brutal economics of the basic economy ticket.
What do you mean by brutal economics?
Well, the unbundled economy seat is a highly commoditized product. Passengers who are just sorting by the lowest price on a travel aggregator, they have zero brand loyalty.
Right. They'll fly whoever's cheapest.
Exactly. It is a race to the bottom that leaves airlines wildly exposed to macroeconomic downturns.
So by building out the Atmos ecosystem, securing those corporate contracts, and expanding the premium cabins, They are engineering revenue diversification.
Precisely. It's the term management uses all the time. Durable, resilient earnings power.
Durable earnings. Okay.
When a consumer holds the Atmos credit card, they value their priority boarding, and they rely on the Starlink Wi-Fi to work during a flight. They are inherently sticky.
Right. They aren't going anywhere.
Right. They will choose Alaska even if a discount carrier is offering a route for $30 less. This loyalty creates a recurring revenue baseline that severely diminishes the company's vulnerability to sudden shifts in, consumer discretionary spending.
But that ecosystem, it only really holds value if the airline is flying to destinations the premium traveler actually wants to visit.
Yes, very true.
Which brings us to the geographical footprint of the combined network. Because the Q2 narrative highlights a pretty stark contrast between a highly challenged stronghold in the Pacific and a rapidly scaling international venture out of the Pacific Northwest.
It really is a tale of two geographies.
Let's dig into the headwinds battering the Hawaiian market first.
Yeah, the Hawaiian market was uniquely volatile this quarter. First, they faced severe, historically anomalous rainstorms across the island.
Just terrible weather.
Terrible. And management calculated that these climate events caused a direct 3-point drag on total unit revenues for the quarter.
Wow. Just from rain.
Just from rain. Because it didn't just suppress immediate travel, the negative weather coverage actively depressed peak summer bookings as tourists, pivoted their vacation plans to alternative markets.
Right. If you see it's pouring in Hawaii, you'd book a trip to Mexico instead.
Exactly. But the weather was honestly only half the problem.
What was the other half?
The broader aviation industry sensed a post-pandemic leisure boom and aggressively dumped capacity into Hawaii. Competitors flooded the market with 7% more seats.
Oh, man. So way too much supply.
Yes. When you inject that much excess supply into a finite island market, while demand is simultaneously softening due to bad weather, the pricing floor just completely collapses.
Right.
Airlines slash yields just to avoid flying empty metal across the Pacific.
But management did note that forward-looking data for the fall shows demand and yields rapidly stabilizing back to historical norms, right? Like as competitor capacity kind of normalizes.
Yes, that is what they are guiding for.
But I have to pause on their strategic logic here.
Okay.
If Hawaii is supposed to be this crown jewel, right? This $8 billion premium leisure market, yet it just suffered a massive unit revenue collapse because of a few bad weeks of rain and Southwest Airlines throwing some extra planes at it.
Yeah.
Isn't Alaska wildly overexposed here? Why heavily concentrate your network in a geography that is so hypersensitive to both climate shifts and competitor capacity dumping?
It's a great question. And honestly, the analyst community hammered management on that exact vulnerability during the call.
I bet they did.
But if you look at the underlying mathematics of their long-term strategy, the short-term volatility in Hawaii is essentially just the cost of entry for a much larger global play.
Okay, explain that.
Hawaii is a geographically constrained market. You cannot endlessly build new beachfront hotels or expand rental car fleets on an island. Right. Over a 10-year horizon, it remains an incredibly scarce, high-yield premium destination that perfectly complements their loyalty-driven business model.
So they view the current capacity dumping as just like an unsustainable short-term anomaly by competitors who will eventually just bleed out and retreat.
Exactly. But the more crucial strategic layer here is fleet synergy.
Fleet synergy.
Yeah, integrating Hawaiian Airlines gives Alaska immediate access to a fleet of wide-body aircraft. Planes that are capable of flying true long-haul international routes. So they are utilizing the established Hawaiian routes to generate cash flow while actively deploying those wide-body assets to transform their Seattle headquarters into a massive Tier 1 international hub.
Oh, wow. And the early data on that international pivot is highly encouraging, isn't it?
Very encouraging.
Because the transcript details the launch of highly successful long-haul routes directly from Seattle to Rome, London, and Reykjavik.
Yeah.
But what really proves the entire integration thesis is the passenger composition on those specific flights.
Yeah, this is the best part.
A full 50% of the travelers on those new European routes are Atmos loyalty members.
And that is the ultimate validation of the ecosystem. The frequent flyer who lives in Portland or San Diego, they're accumulating miles through their daily corporate commute and their co-branded credit card.
Right.
And they are now burning those miles for a highly profitable premium summer vacation to Rome entirely within the Alaska Air network.
Keeping the money in the family.
Exactly. The domestic loyalty flywheel is directly subsidizing and de-risking their massive international expansion.
They are also optimizing their metal on the cargo side, too.
Yes, they are.
They're taking delivery of 4 new Boeing 737-800 freighters, specifically tailored for the heavy logistical demands of the Hawaii and Alaska markets. And that investment is already generating returns, with cargo revenue jumping 21% in the quarter.
Which is fantastic.
Furthermore, they made the definitive call to retire their aging fleet of Boeing 717s by 2028.
And that 717 retirement is a really vital cost control measure. Those airframes are a quarter-century old.
Yeah, they've been around.
The maintenance burden and the fuel inefficiency of operating older, out-of-production aircraft is a massive drag on operating margins. So transitioning to a streamlined fleet of modern, highly efficient Boeing jets, it drastically reduces their long-term maintenance liabilities.
Which perfectly sets up the analysis of their forward-looking financial health.
Yeah.
With the operational integration complete and the fleet modernizing, we have to evaluate what management is actually guiding for the back half of 2026.
Right, looking ahead.
Looking at the balance sheet, they are currently sitting on $3.8 billion in total liquidity.
That's a lot of cash.
And they recently tapped the debt markets to raise an additional $1 billion, which notably included their first ever $500 million unsecured bond.
And successfully floating a $500 million unsecured bond in the current macroeconomic environment, that is a significant signal.
Why is that?
It indicates that institutional credit markets have deep fundamental confidence in Alaska's long-term cash flow generation and the structural integrity of this Hawaiian integration.
Okay, but if you are a retail investor looking at their leverage metrics, you are likely sweating right now.
Yeah, the debt is high.
Because their debt to capitalization ratio is sitting at an uncomfortably high 65%. Their trailing 12-month adjusted net leverage is pegged at 4.8 times.
Right.
So they lost roughly $500 million in the first 6 months of the year. They are leveraged at nearly 5x. And yet they are hoarding nearly $4 billion in cash instead of aggressively paying down that massive debt load.
I see where you're going with this.
Yeah. Is this balance sheet actually secure, or is management playing a dangerous game with their capital structure?
Look, it is a highly defensive posture engineered for an inherently unpredictable industry. Yes, the 4.8 times leverage ratio is elevated, but in the aviation sector, liquidity is the ultimate insurance policy.
Cash is king.
Absolutely. If a geopolitical crisis erupts tomorrow and sends jet fuel back above $5 a gallon, or if a major macroeconomic recession crushes consumer travel demand, that $3.8 billion cash reserve is literally the only thing preventing a liquidity crisis.
Okay, so it's a war chest.
Exactly. Management articulated a very clear sequence of priorities. Maintain the defensive cash buffer through this volatile fuel environment, wait for the integration efficiencies to generate a quarter or two of predictable free cash flow, and then violently pivot toward aggressive debt reduction.
Let's look at the Q3 guidance to see if that predictable cash flow is actually materializing.
Okay.
They are projecting incredibly lean capacity growth, keeping it artificially constrained to just 2 to 3%. And almost all of that growth is dedicated to the new intercontinental routes rather than, flooding the domestic market.
And that strict capacity discipline is a lever to enforce pricing power. By keeping seats scarce domestically, they force yields higher.
Right. And the massive relief valves is coming from the commodities market. Management is projecting fuel costs to drop precipitously from that agonizing $4.43 a gallon down to a much more manageable $3.75 for the third quarter.
That's a huge tailwind.
It is. Combining the constrained capacity with the massive drop in fuel, they are guiding for Q3 earnings to land somewhere between break-even and $1 per share.
Right.
But the true test of their operational efficiency really lies in their CSMX metric.
Yeah, and for context, CSMX stands for cost per available seat mile, excluding fuel. It isolates the pure, controllable operational costs of running the airline. So labor, maintenance, airport fees, and technology.
Right. And in the second quarter, their CSMX surged by 6.5%. Now, on paper, a 6.5% spike in operating costs looks like a severe failure in cost control, especially when capacity is essentially flat.
It does look bad on paper, but management heavily contextualized that 6.5% figure as containing a massive load of transitory, non-recurring expenses.
So one-time hits.
Exactly. They absorbed heavy one-time costs associated with cross-training flight crews on the new fleet types. And more significantly, that figure includes the massive employee recognition payouts and bonuses distributed for successfully completing the dual brand PSS integration without an operational meltdown. So it was basically the financial hangover of the merger.
Yes, exactly.
And the guidance backs that up. They project that as those one-time integration costs fall off the ledger, CASMX will step down aggressively into the low to mid-single digits in the back half of the year.
Right.
The entire thesis of this company right now hinges on what analysts call the controllable margin spread.
Right. Growing revenues faster than costs.
Right. If they can keep unit revenues accelerating through their premium cabins and loyalty program, while simultaneously crushing their non-fuel costs back down to low single digits, the profit margins they'll explode.
And management is telegraphing massive confidence in that exact scenario. They utilize the earnings call to forcefully reiterate the ultimate objective of their Alaska Accelerate strategic plan, which is achieving a staggering $10 of structural earnings per share.
A $10 EPS target is wildly ambitious.
It's very aggressive. But looking at the granular data, if they successfully defend their corporate market share in the Pacific Northwest, stabilize the yields in Hawaii, and continue printing cash through the Atmos credit card flywheel, a $10 per share reality is mathematically viable over the next 24 to 36 months.
It really is. So, we have dissected a massive amount of operational and financial data today. To synthesize all of this for you, the retail investor trying to decide how to position your portfolio, we really need to clearly define the fundamental bear and bull cases emerging from this Q2 report.
Let's outline the bear case first, because the risks are highly visible.
They are.
The primary bear thesis is that the airline industry remains fundamentally fragile and hyperexposed to external shocks. As this very quarter proved, you can execute a flawless technological integration and optimize your revenue engine perfectly. And a sudden 70% spike in global crude oil will still wipe out your profit margin overnight.
Right, you can't outrun the price of oil.
Exactly. Furthermore, their outsized bet on the Hawaiian market remains a glaring vulnerability. It is highly susceptible to climate disruptions, and their competitors have repeatedly demonstrated a willingness to irrationally dump excess capacity into the islands, utterly destroying pricing power for everyone involved.
That's a brutal market dynamic.
So if you buy Alaska Air, you are accepting that massive geographic and geopolitical risk.
But on the flip side, the bull case requires looking past that headline volatility and focusing on the underlying structural transformation.
Right.
Because Alaska Air Group just successfully executed one of the most notoriously dangerous maneuvers in corporate aviation, a dual brand IT integration, while simultaneously improving customer satisfaction and on-time performance.
It's just unheard of.
Unheard of. And they are actively draining lucrative corporate market share away from the entrenched legacy carriers. Their Atmos loyalty ecosystem is generating nearly $700 million in high-margin cash a quarter.
Just staggering amounts of cash.
And they are successfully rewiring their entire physical product to capture the high-yield premium and international traveler. Structurally, despite the Q2 net loss, they have engineered a vastly superior, more resilient business model than they operated a year ago.
Which leaves me with a final, slightly provocative thought for you to explore as you evaluate this stock.
Oh, I like this.
Because we have spent this entire deep dive analyzing Alaska Air as a traditional airline, focusing on seat miles, fuel hedges, fleet maintenance, and ticket yields.
Right.
But when you step back and look at the actual source of their cash flow, the paradigm shifts. If a company is generating the lion's share of its high-margin revenue from selling a digital currency to a massive banking partner, locking consumers into a subscription-style loyalty ecosystem, and monetizing premium lifestyle upgrades like satellite internet and first-class lounges, are we valuing them incorrectly?
Right. It forces a total reevaluation of the multiples applied to the stock.
Exactly. Should we, as investors, stop analyzing them purely as highly volatile, capital-intensive transportation companies at the complete mercy of bad weather and jet fuel?
Yeah.
Perhaps it is time to start analyzing companies like Alaska as premium lifestyle and fintech brands that simply utilize a fleet of airplanes as the physical acquisition funnel for their financial products.
That's a fascinating way to look at it, because if Wall Street begins to price in that fintech reality, the upside potential of this stock radically changes.
It changes everything. And the ultimate stress test for that fintech valuation theory and the $10 EPS target is rapidly approaching.
It is.
Keep your eyes locked on September 29th. Alaska is hosting their highly anticipated Investor Day at their new Global Training Center in Seattle. That event will be management's moment of truth, to lay bare the specific mathematical roadmap proving out their structural earnings path. Thank you so much for joining us on this deep dive. Keep questioning the data, and we'll catch you on the next one.